Know what the order is. It's going to be fun.
I think it's
Hey, hi everybody. Good afternoon, everybody. We'll give everybody and some people that would like to join some time to join, but we'll go through the intros. As always, we have me and Ali. We're hanging out here at the office, and today we have Michelle joining us as our guest. She is a mortgage expert. She knows all about mortgages all over Canada, which is fantastic. We'll give her a chance to introduce herself. Michelle, tell us a little bit about yourself and what you do and what you get at.
Yeah, first of all, thanks for inviting me. I appreciate that. I am a mortgage broker. My team is Cognitive Capital. We're part of Mortgage Outlet, which is one of the largest independent brokerages across the country. That's really awesome for us because it gives us a really cool reach in terms of the amount of lenders, credit unions, private lenders, banks, and all the good things that different types of clients would need. And me personally, I am you call me a mortgage expert. I call myself a mortgage nerd. Sometimes I think it's a little embarrassing how much I know about mortgages. um, yeah, I'm excited to chat about this today because I know that a lot of people have a lot of questions and hopefully we can answer some of those.
Oh, there's going to be some questions. It's going to be good. And we also can't forget about Sonia. She is our buyers specialist in north of Brampton, Caledon. She knows all about this area. She's got her finger on the pulse of what's happening. And I think she'll bring a very unique perspective on what's happening out there. Me being the listing agent and she knowing everything that is going on with the buyers out there. I think we'll be able to pose some good questions to you today.
Yeah, awesome. For sure.
All right. Awesome.
You should call yourself the mortgage champion. That's what I'm telling you.
All right, I'll consider
awesome. I like that. Lots of good names today. So let's get going. Let's get started. And we'll dive into what's happening right at this moment with the interest rate rise, which first was predicted as, oh, it might just be another, 25 basis points. Then it went to 50. Then it went to, okay, it'll probably be 75. And then some people were saying one. Then some people were saying, oh, it's not going to happen now. And then it came out at 75 basis points. So just to sort of throw it at you to kind of give us more logic on why this is happening. Give us why this is a good thing.
Yeah, I was really excited to see it at 0.75. And I know that people don't like that opinion, so to speak, because it's really easy for us as homeowners, prospective buyers, to think of this just simply from a consumer level. I think that in general, Canadians have proven to be a very short-sighted financial population for a very long time. We can see that in our consumer debt. We can see that when we look, over history at the way that Canadians choose fixed versus variable in their mortgages and in the way that they pay penalties on their mortgages. I think, as I said, it's important for people to really zone out and understand that your home and how that ties to kind of the rest of the economy. We're really looking at a business, everything that the government is doing or the way that we're seeing an economy flowing. This is not just, something that's tying into your social life or your personal financial life, but there's a bigger picture going on here. I think how we ended up with reports that there was going to be no rate hike at all is because we did see the inflation numbers trend downwards, which I personally am very excited about. But people also need to understand that there's many different markets that tie into inflation, and fuel has been a very large part of impacting inflation both up and down over the last little bit. So that rumor, I think, circulated that way. I was happy to see this increase because I want to get through this just like everybody else does. And it's kind of like ripping the Band-Aid. The sooner and the more aggressive that we are about it, the sooner we're going to be at the tail end and we're going to be able to see rates come back down. It's definitely a little bit uncomfortable in the short term, but it's really necessary for us to kind of make our way back to more stable interest rates, which for me is kind of pre-pandemic levels. Oh, we have a slide.
Yeah, we have a slide. So I'm muted now. How do we unmute here? There you go. So we're live. So we'll put on some slides as we go forward. So this is sort of kind of to show what's happened. Thank you for articulating that for everybody. It really does put in perspective that fuel variable has really caused some pain for a lot of places. So we're kind of experiencing pain on both ends on buying goods and also on mortgages. So that's definitely been a bit of an impact, but just like you're saying, it will make a difference in in our inflation numbers. So we're definitely starting to see that. And it was time, I think, and it is sort of overdue with the housing prices, because in my opinion, the housing prices did go up way too fast and way too much. And now we're sort of seeing a good adjustment where it's coming down to a place where a lot of people are able to maybe start to think about, hey, maybe I can afford a house now. And just in terms of prediction, to sort of wrap this one up, do you see there being more of these hikes? Because I know there's a few more coming up for the year.
Yeah, I think that we're probably going to see somewhere between 1/4 and 1% more before the end of the year. And very simply put, it's really important for homeowners, prospective homeowners, to educate themselves on basic economics. And just to keep it very simple, the cost of things and the demand and the price of things do not have, a parallel relationship. Like, they have an inverse relationship. So we are seeing those prices come down. I'm not the type of, real estate or mortgage professional who's always going to say this is the right time to buy. I really think it's dependent on the specific person. I'm seeing so many first-time buyers circle back and have so much fun in this current market because they couldn't get their hands on a house previously. And they're willing to, kind of hold over a bit of a higher monthly payment for right now to be able to secure a property and get their foot in the door. So
yes. And what we're seeing on this end, sorry to interrupt, we're seeing that where listings are going up for what it should be worth. And in this big market, and then the smaller market where people are sort of dictating prices. So say they're listing a home for about 800,000 where it should be worth. Home buyers are able to go in there and save $150,000 off that price, because the seller is actually a lot more realistic now, and they're seeing the trends, and they're saying, let's just get it done with, because then obviously we're going to save on the other end as well. So everybody's sort of adjusting their expectations. And that's, I think that's, no matter what your interest rate is at, if you're saving $150,000 over a few months ago, that's amazing.
Absolutely. And real estate used to be something that I think was a right. And now it's very much a privilege. And whether we like that or don't like that, that's a fact. And there's so many other things that are contributing to what's going on in the market here. For example, we very much do have a supply and demand issue. And we very much are a country that immigrants look to come to and create a better life here. And all of those things are going to contribute to kind of the prices that we're seeing, and maybe not as large of a drop in prices that people would assume based on interest rate hikes. So it's not as simple as just interest rates and prices. There's a couple other factors. But I really think it's important for buyers to kind of step back and speak with their real estate and their mortgage professionals and say, okay, what are my goals? And then at what time can I make those goals happen? And I'm speaking from a position of, I'm in this. I just bought another house yesterday, actually.
Nice.
I was up for 2 in the morning. It drives me nuts how you real estate people like do business so late at night. But, I bought a house in a year ago, and I just bought another house now. Markets are different. The goals of what I'm expecting from those houses are different. So I think it's really important for buyers to really hone in on what those goals are for them and work with your real estate team to find it.
Yes. And from the mortgage perspective, would you say it's still a good idea to get those variable rates? Because, and I'll tell you why I'm saying this, because for me, it makes sense, because sure, it's, the rates are high right now, and I'm on variable for all my properties. So I know that's eventually going to come down again. And I'm thinking in my head, my prediction, and as sort of somebody, that does invest, that by next year, we're going to start to see a curve down in terms of this inflation. And then we're going to actually be in a deflation where the government's going to have to bring those rates down to be able to pump some more money into this economy.
Yeah, I think it's a wonderful question. And I think there's something very specific that you said there that's important to note when I answer this, which is that you are somebody who is a real estate investor, be a business owner, you're very entrepreneurial. So your risk tolerance towards these type of things is potentially significantly greater than the average homeowner who's purchasing a home strictly for the purpose of shelter and wanting to stay in that home for however long, and maybe will never purchase a second home and they'll always only own one. So right now we're in an interesting spot where after the last rate hike, we're seeing for insured mortgages, interest rates within 10 to 15 basis points of each other for fixed and variable. I personally am a variable junkie. Even if it's going to cost me a little bit more in the short term, I want to be able to like move as quickly as I can, because I think of it from an investment standpoint. And do I want to take out equity? Do I want to sell it? I don't know. And I just don't want to be tied into that, but I'm comfortable stomaching the change. So what we've seen over the last year is that people actually didn't really have an option. Most of my clients over the last year are in variable rates, and they were in variable rates because they could not get the budget size that they needed under the fixed rates to be competitive purchasing and securing the home that they wanted. And this is something that we see actually as an issue with a lot of buyers from my perspective. And I'm just going to give it to you guys straight, is that everybody wants everything that they want, and they don't necessarily want to make sacrifices. So a lot of people took out variable rates, understanding, you know, this is going to go up, something's going to happen here. And their option was you either take a fixed rate and you make a sacrifice on some of the must-haves in your home and get a property that's maybe not quite as nice or as big or in the area or whatever it is, or you maximize your budget and you take a variable rate. So again, this comes back to kind of, you know, Canadians need to work on thinking a little bit more long-term about things, because in the short term, they wanted the biggest budget. They wanted the best house that they could get their hands on. And now there's people who are upset about being in a variable rate mortgage, but it was the only option that they had to secure that property that they wanted.
Yes.
So now variable rates, I love, but because they're so close, I personally am also recommending 1 to 3 year fixed rates. I never like a 5-year fixed rate personally. I've seen so many things, like people break their mortgages all the time. And when they're in a 5-year fixed, it's harder for us to get to that point where there wouldn't be a penalty to get to that renewal, whatever. So 1 to 3 years, I'm calling this the ostrich approach. Ostriches, they stick their head in the sand and they let the storm blow over. You can do that with a 1 to 3 year fixed rate. Somebody who takes a 1 year is maybe somebody with a higher risk tolerance. You know that maybe they come out in a year, maybe rates haven't quite gone down yet. Somebody who's a year has a bit of a lower risk tolerance. They know that, okay, maybe next year rates are going to come down and then I'm going to have to hold out in a higher rate for another 2 years if I don't want to pay a penalty to drop to something lower.
Yes. And I don't want to get too technical with this, but when they started that stress test, they were sort of thinking of these times where we might be, you know, coming up to these kinds of rates, and they have sort of tested folks to be able to handle this kind of thing. Am I wrong in saying that that's already sort of baked in for them, and they know that, you know, there's not going to be that many people that are going to be defaulting on these mortgages that are, you know, higher rates? You're
dead right. The thing about the stress test, though, is that the stress test doesn't factor in childcare costs. The stress test doesn't factor in somebody who has a online shopping problem, right? So what we see is that people get really used to functioning at whatever they start at in their variable rate. And this is why it's always important. And I encourage people, come back to your budget. Are you saving money? Because yes, a home is a great investment, but it should not be your only savings strategy. And the reason that that's important is because what if your savings strategy came to an end, so to speak, in this market, and your game plan was to sell? And now maybe you don't have as much equity as you would have had a year ago, and maybe you were banking on that. So it's important for people to make sure that they have surpluses that they're putting aside and still be living slightly below their means. I want people to enjoy their life, but we have factored this in from a qualifying perspective for the most part, obviously excluding some things that the stress test could work on, like childcare, groceries, whatever. But you shouldn't be living right at the edge of your seat kind of thing. You got to make sure that you have a little bit aside. And I think the clients who do that are digesting what's going on right now very well.
Yes.
Obviously, we want it all as cheap as possible, but that's not how the economy in the world works.
So us acting as professionals and, you know, wanting to do a good job by our clients, it's not, hey, you want to buy a house? Okay, get in my car. Let's go buy a house. And you getting them approved on whatever way you can. It's actually assessing them and saying, hey guys, this might not be the right house for you, or this might not be the right time for you, because you might be able to buy this house and close on it, but you're going to go bankrupt in a few weeks.
Absolutely.
Makes sense?
And yeah. And that's why I try very hard to connect with, you know, real estate agents, especially who share that view with me, like your team. You wouldn't hesitate to say, hey, like maybe this is a bit of a stretch.
Yeah.
And we've gone through that scenario, I think, a couple of times actually. And I think that's more refreshing now, because there's a lot of people that will try to stretch the limits, and for some people, it just doesn't work, and you have to be able to tell them that right away, and I do appreciate that you do that.
Absolutely. And you do the same. There's one client specifically I'm thinking of, but it's
Yeah.
like, and if they decided to make that decision, at least we know that they made that from an informed space.
And they gain this trust for you at that point, right? Where they realize
Yes.
that you're looking out for them, and that's, you're looking out for their best interests. So
I think folks appreciate blunt honesty versus fluff.
sure. For sure.
Totally agree. And listen, I don't think you become an expert in your space just strictly based on, the volume that you close or the number of transactions that you do. I think you become an expert in your space based on the level of transparency that you hold when you're running your business. Right. And I think that's proving more important now than ever. I actually saw a client over the weekend who's also a friend, and they were like, we're laughing. We have a 1.7 fixed.
Wow.
And they are like one of few clients who took my advice when they were house shopping. And I said, listen, if something changes $20, $50, $100, how do you feel? And they had a co-sign on it. And, they were kind of pulling every penny together for down payment. And they said, we can't handle that. And I said, so why don't we scale back the budget a little bit and let's get you into a fixed rate? And they did it, and they love their house, and they're super calm, and they're super happy, and they're sitting at a 1.7 fixed rate.
Yeah.
Awesome.
No,
right. So
that's awesome. Yeah. So while we're on that subject, let's look at, if possible, and I don't expect you to be bang on with this, but what kind of pain are these folks feeling? So let's say, what's the average mortgage these days? Say in like the Orangeville area, 500,000, something like that, or lower?
Somewhere around probably 5.
Okay, so let's say somebody with a $500,000 mortgage. Let's look at from when these rate hikes started till now. How much more in the last few months are they paying? Looking at a $500,000 mortgage.
$750 a month, if I'm assuming that it's around $37,500 to $40,000 for every 0.75% increase. Like that's what we just saw. It's around $37,500
on your toes math.
No, yeah.
Yeah, for that last rate hike per 100,000 that you borrow. So for example, I looked at this, like somebody who's in an $800,000 mortgage who took it out before the first rate hike, their payment is up about $1,200.
Okay. If you have an $800,000 mortgage, obviously you're well qualified and you probably have a pretty expensive house. It's not going to be a $850,000 house and you have an $800,000 mortgage. Fair?
Exactly.
Okay. So, so anybody around 500, they're looking at an extra $700.
Yeah.
Right now. Okay. So I looked at this from the perspective of an investor. Say if you have 5 properties, and these have $500,000 mortgages, that's 750 times 5.
Yeah.
So that's quite a lot of increase. So, and when people say that to me, I think to myself, you obviously should have set up the cash flow so you make sure you have enough money to cover that. And with rentals these days, rentals will cover that because you'll be able to cover that extra amount and then be able to write it off afterwards because obviously this is money you're spending on your property and it's your business. So. Yeah. Don't think about it that way. If you're just getting into your first one or second one, this is just short-term gains. Now is really still the time to buy, I think, for an investor because you're going to make that money back.
I agree. And listen, a lot of my really intelligent investors took every single dollar they could out of their properties in January. And the reason that they did that is they knew that the property values are going to come down at some point. We're seeing rate hikes. They pulled out every dollar they could. And now they're probably pretty close to at 100% loan to value on their house, but they're investors. And I think it's really important. There's so much like hustle culture on Instagram and on TikTok, and there's a lot of misinformation that goes around. On the one hand, I love that we're spreading knowledge. But on the other hand, I think it's super important for people to have discussions with people that you trust who do this every single day. And the reason that I say that is if you go on social media, all that people talk about in regards to real estate that I see is they're talking about cash flow and they're talking about how to figure out how to have 100% financing and not put a dollar of your own money into things.
Yeah.
When I step back as somebody who owns properties, yeah, cash flow would be amazing. But what about equity appreciation? So if we go through hikes right now and my cash flow is affected, if I actually step back and I look at the fact that somebody is paying down my debt, am I short $200 a month? Okay. If I take that $200 a month and I look at the average appreciation on a property per year, I am still up.
That's right.
There's so many more things that people need to be looking at than simply cash flow. And if you really want to be a property investor, everybody's trying to get their hands on property. This is like running a business. It's entrepreneurship. It's why the government is changing tax laws surrounding how we buy and sell and own property, right? So there's so much more that I think people need to think about. And me personally, I just got an awesome property. It looks like it's going to cash flow, and I'm excited about that. But to me, that was the cherry on top.
I think, being somebody that wants to get into this business, if you're somebody that wants to get in this business, first, you want to have some guts, you got to have a strong stomach for certain things.
And you got to ride the wave. Like, a lot of people have been talking about these rates, and we understand they're like this, right? Especially the variable.
That's right.
If you can ride the wave, then you're good.
100%. And you got to do your research, and don't just be like, well, some guy did it on Instagram, so I can do it too. Exactly. Great. Sure, you can do it, but do your research, really get down into the nitty gritty, because this is like your business. We're
not buying and selling hamburgers at McDonald's. We're talking about millions of dollars, right? Like,
that's right.
There's barely overnight get rich quick type thing in any aspect. And for people to think that they could put $0, win every single year on interest rate and appreciation, like, you're going to have a mortgage for 25 to 30 years if you never refinance it and you never make a prepayment. You cannot predict what those rates are going to be. So if the price is right for you and you see an opportunity to grab the 3-bedroom, 2-bath house that you want for your family, grab it. The interest rate's going to change.
That's right. That's right. And you just ride it where it goes, like Sonia was saying.
Can we touch on, one buzzword that I'm seeing a lot, which is trigger rates? And
I was just going to ask about that.
Yeah,
you
because
stole my thunder.
I've seen it explained well, and I've seen it explained like botched in explanation.
Love it, Sonia. How do you read my mind?
I don't know.
You're so in sync.
100%. I was going to ask about that, and this is something. And again, I didn't want to get too technical with this, but if we could explain in layman's terms, what is this trigger rate and what does it do?
Yeah. So I actually just got off like a 1-hour meeting with a big bank, specifically talking about this as well. So a trigger rate is essentially an interest rate at which, once there's been enough rate hikes and you hit that, now your loan can actually grow, right? Because your payment's not fluctuating. A trigger rate is on a variable rate mortgage that your payment is not moving. It's the division of principal and interest within this that's changing. So your balance can grow or your amortization can fall out of line. The trigger rate is not the thing that people should fear. Like, obviously it's not wonderful, but it's the trigger point that people should fear. And what a trigger point is once you've hit your trigger rate and now there's not enough of your regular payment to cover the interest costs and to pay principal, your loan starts growing and your amortization starts stretching. There's a trigger point, and this is different for different major banks. For example, one bank has a 5% kind of buffer. Another bank bases it on once your loan grows higher than 105% of the original principal balance, we're going to call the client and we're going to give them 3 options. Option number 1 is you make a lump sum payment to bring this below that. Option number 2 is you build a prepayment onto your regularly scheduled mortgage payment. Option number 3 is we're locking you into a fixed rate. The trigger point is something that people can stay away from, and people who are in these mortgages really, I think, need to focus on their mindset, because again, we all love everything cheap. We all love everything perfect. That's not realistic. Yeah. I have one of these mortgages, and the reason that I took this mortgage is it was giving me flexibility of a variable rate with some stability over my cash flow. While other mortgage rate holders, for example, that 800K mortgage example we used, they have been forced to now have $1,200 more a month leaving their pocket. You, as somebody with a trigger rate and a trigger point, have not had that challenge. You have the ability to say, I'm just going to build $500 onto my mortgage, and every dollar of that 500 is going to go towards principal, and it's going to keep me away from that trigger point. Right. That's a level of control that's super valuable.
So it's just a prepayment, correct?
Just to clarify quick, would you have known if you signed up with something with the trigger rate before you signed up for it?
Yes. So if you're a variable rate mortgage holder and your payment is not changing every month, you are in a variable product that would have a trigger rate. If you've done your mortgage through a mortgage broker, the trigger rate is not going to be on your mortgage loan commitment. It's going to be on your mortgage loan agreement, which is a document that you would have signed with your lawyer.
So do you get some kind of
Everybody
warning
reads those.
when this is going to kind of pop up for you, or is that something you are supposed to be aware of? How does
You
that
should
work?
be aware of it and keep an eye on it. And here's what I don't like about this situation. I'm really disappointed in major banks for this. They cannot give you a calculation on how to calculate your trigger rate once you start making prepayments.
Yeah, that's a little.
And I was speaking with somebody very high up at a bank that I'm not going to tell you their name today. And I said, listen, I'm disappointed in this because how am I supposed to have conversations with clients and tell them, hey, I actually don't know what a good number for you to build on for prepayment is, because the bank can't calculate it. It's a reactive calculation. So if you build on a prepayment, you'll basically get a statement a month later, kind of with like an adjusted trigger rate. And you kind of have to watch your amortization yourself. So the conversation I'm having with clients is the trigger rate's not the problem. It's the trigger point. And we want to stay away from the trigger point.
Yeah, it's a little that's really disappointing because the everyday, person, consumer, how are they supposed to know that? We're teaching them basic economics every day,
I know.
So how do they get to that point?
I'm obviously a little bit biased, but I think that this kind of brings me back to a base conversation of we're in a society now who's been kind of, the younger generations have lost trust in a lot of institutions. And we see things like brokers or independent consultants. Their industry is really growing because we have a stake in having good relationships with a client.
And we're sharing knowledge, I think, more than the average person.
Exactly. A bank is a massive, massive company, and their main number one goal is to drive profits for themselves and shareholders. And I think people need to keep that in mind. Right. And listen, I don't love this situation. I have a mortgage with them and I'm just shooting randoms, hoping it sticks. Like, I don't know. But the best thing that people can do is look at your budget. What's realistic for you right now? Don't put this off because time is your best friend in this situation. The more monthly payments you can get in or biweekly with that prepayments on it, the less likely you're going to be in an uncomfortable position hitting your trigger point.
Very good.
I think that was great. Thank you.
Yeah. Thank you for articulating these answers so nicely, so everybody can understand. And if anyone has further questions, which I'm sure everybody will, we do have one question. Yes. Let's see. What's the question? All right. This is from our friends at Mayor Harmon team. When do you think market values will stop declining? I think that's more of like I think it's pretty.
This is where Michelle's crystal ball comes into play.
Yes.
Do you have one of those?
I wish I did. It's such a tricky question to answer because if I look at how much interest rates have increased versus how much prices have declined, and then across different markets.
Is there there's no way to really be able to be like it's in correlation to this,
And like when you think about the fact that, an 800K mortgage holder has had a $1,200 a month increase on a variable rate mortgage, like I saw a video on Instagram the other day. I think the average home price in February was like around 1.3, 1.4. I don't know if that was across Ontario or Canada, but now it's like 1.2 ish.
Yeah.
That's not that crazy to me. And if I wipe out that peak and I just pretend like it's not there, like I believe we're still up year over year.
100%. Yeah, we're still up. We're still up since from before pandemic for sure, which is good. And from what I see is it's really more of a stabilization versus a decline, where in the consumer's mind, because now they're set here, so much easier for them to go up in price than for them to come down in price. It seems like such a catastrophic drop where it's more just like a stabilization.
I totally agree. I think it is a stabilization. And I think, we'll start to see, I can't even say that I think this is perfectly tied to interest rates because like I lost a bidding war on a house a week ago.
Oh.
And then I was in a bidding war last night. Like people think that these things are not happening. They're happening less. It's definitely not as hot, but we still have a supply and demand issue. Yeah. So as soon as like different types of buyers come out of the woodworks, there's shifts. So like right now, more first time buyers and investors are coming out of the woodworks because they're realizing the opportunity. Yes. And they want to dive in because they don't want to time the bottom. Because the only way that you know where the bottom is when it starts going back up again.
You got it. 100%.
And my question back to people is like, why do you want to know when the decline is going to stop.
It's they're living on the edge. That's what they're
Yeah.
doing. That's what I
Do you want to buy a house for a good price, or do you just want to wait till everybody else starts buying and pay through the nose for it again? You know?
Yeah. To me, the only person who should be concerned with that is the flipper, the
Yeah.
short-term flipper.
Yep.
Yeah. And that's not an easy business to be in.
No.
First, you got to find that good deal. Then you got to buy your materials at a great price. So,
Yeah.
you know, I think in a steady time, maybe that's a good place to be in. But you know, I haven't found that a very good thing. But that's a whole nother subject.
Yeah.
So
We'll have you
you
back
know,
for that one.
Michelle, thank you so much for being on here with us. I really appreciate it, and the way you put things really is digestible by us and also our clients, which is great. So I'm hoping to have you on here again, so we can throw some more fun questions at you. Hopefully, we'll have we'll have some good conversations over investing, what to invest in, pick your brain on that a little bit on the next one. But
Yeah.
I'm certainly looking forward to it.
Yeah. Thank you so much for having me. This was so much fun. And
Awesome.
I'm looking forward to chatting with you guys again soon.
And we're going to have your information posted below. So
Cool.
if anybody has any questions, and like I said, everybody's going to have a ton of questions as this video gets out there, please put them to us and we'll refer you over to Michelle. Michelle's website will be as well there as well, and her contact information. So feel free to give her a shout too. We'll see you guys next time.
Thanks,
Bye.
Michelle.
Bye. Bye,
Bye.
Sonia.
Bye.